Okay, let's unpack this. The topic today is GEA Group AG, a German technology and engineering behemoth. Now, hearing German industrial giant might make you think of, slow cyclical machinery, but I promise you this is a deep dive into one of the most remarkable and rapid industrial transformations we've tracked.
It truly is. For you, our listener, the extensive source material provided paints a picture of a company that was, frankly, a pretty mediocre industrial performer just 5 years ago.
Mm.
And since then, they've engineered a complete, successful operational turnaround. They've moved from being, well, a structurally inefficient conglomerate to what the data suggests is a highly disciplined industrial compounding machine.
So our mission is to quickly extract that core narrative. We have all the details on their business, the success of their now completed restructuring plan, Mission 26, and of course the launch of their aggressive new blueprint, Mission 30. We need to figure out how did they manage a threefold increase in capital efficiency in just 5 years? And crucially, are the new world-class financial goals they've set for themselves even credible for a company in this sector?
Well, GEA is a global systems supplier, rooted in Düsseldorf with origins dating way back to 1881. They are a fixture on the DAX index, which signals their importance to, the German industrial landscape. Their focus is specifically on critical, non-discretionary end markets: food, beverage, and pharmaceuticals. And that focus gives them an inherent resilience. Their stated purpose is engineering for a better world, which, look, it's more than just corporate fluff. It's really the engine driving their new sustainability-focused growth strategy.
That sets the stage perfectly. Before we get into the incredible financial shift, we really need to understand the gears they turn, because understanding the internal structure is, I think, key to understanding the margin success.
Right.
So GEA operates under a matrix structure. It's made up of 5 distinct technology divisions. This is designed to leverage specialized knowledge across different geographical and end market needs. But as you alluded to earlier, the differences in profitability between these 5 segments, that creates some fascinating internal dynamics.
It's organized complexity, but it's absolutely critical. You can't run a pharmaceutical process line the same way you run a dairy farm automation unit. It just doesn't work. So by segmenting into 5 divisions, they maintain that market specialization while benefiting from shared R&D, especially around, say, automation and separation technology. However, the profitability disparity among them is the absolute single most important structural fact for anyone analyzing this business.
Okay, let's start with the crown jewel then, the segment that provides the stable, high-margin fuel for the rest of the enterprise. Separation and flow technologies, or SFT.
SFT is the company's financial anchor, no question. This segment sells critical components, the separators, the decanters, valves, pumps, that are the non-negotiable core of any major processing line. You should think of them as the high-precision internal organs of the customer's factory. Because of their specialized, proprietary nature and the critical role they play, SFT generated an adjusted EBITDA margin of an eye-watering 27.4% in fiscal year 2024.
Wow.
Yeah, this is an elite margin, putting it in the same league as the best pure-play technology component suppliers globally.
27.4% is truly remarkable for an industrial firm, but that figure really snaps into context when we compare it to the segments that handle the massive complex projects.
Exactly. Contrast that with liquid and powder technologies, LPT, which is actually their largest segment by revenue. LPT designs and installs these massive customized processing lines, specializing in everything from large-scale dairy drying systems to complete food processing solutions. These are large capital expenditure projects, which means they involve more execution risk, longer lead times, and, inherent margin pressure.
Yeah.
So as a result, LPT's margin in fiscal year 2024 was significantly lower at 10.6%.
Right, and the margins are nearly identical for food and healthcare technologies, FHT. That segment focuses on production lines for meat, poultry, and importantly, critical pharmaceutical applications like freeze-drying technology for sensitive vaccines and active ingredient production. They clocked in at 10.2% adjusted EBITDA margin.
So we have the dynamic right there. The lower margin, project-heavy segments, LPT and FHT, are the revenue drivers, but the high-margin component business, SFT, is the engine of overall profitability. The other 2 divisions kind of fill out the middle ground.
Okay, so that's Farm Technologies, or FT. It's focused on automating the dairy side of the value chain with automated milking systems and digital herd management. That one achieved a pretty solid 15.3% margin. And this segment really benefits from the trend toward high-tech, efficiency-driven farming.
It does. And finally, you have heating and refrigeration technologies, or HRT. This one is the most strategically aligned with the green CapEx trend. It focuses on sustainable energy solutions like industrial heat pumps and natural refrigerant systems. Their margin was 12.9% in 2024. So the overall group average, pulled way up by SFT and all the operational fixes, landed at 15.4% in 2024.
The insight here is crucial then. The high-margin SFT segment provides the strategic cushion. So when LPT or FHT take on a large, potentially competitive, lower-margin project, the overall profitability is structurally subsidized and protected by that 27.4% that SFT brings in. This makes the total GEA business model far more robust than if those project segments stood alone.
That's the entire point of the matrix structure. It's an internal transfer of stability. And let's look at where they deploy this machinery.
Yeah.
Why does focusing on food and medicine give GEA such an advantage in terms of resilience compared to a general industrial company that serves, say, mining or construction?
Well, those sectors are hypercyclical. I mean, when the economy tanks, capital expenditure on new mines just stops immediately. But people still need to eat, and they still need medicine.
Precisely. GEA serves fundamentally non-discretionary sectors. Demand for processed food and pharmaceuticals doesn't just collapse in a recession. It might slow down a bit, sure, but it doesn't halt. This makes their earnings stream much more predictable. We do have to note the concentration risk, though. The dairy value chain is a massive part of their business. It accounts for approximately 30% of sales.
That's a big number. That large percentage makes the company susceptible to global milk price volatility or, major shifts in global dairy policy. How does management mitigate that specific concentration?
They mitigate it through geographic spread and technological diversification within the dairy space. They sell systems in Asia-Pacific, North America, and Europe. In fiscal year 2024, no single region dominated, which offers a crucial smoothing effect against localized economic shocks. Asia-Pacific was the largest region at 21.4% of sales, closely followed by North America at 20.1%. So if one market slows, others can compensate. It protects that 30% dairy exposure from total collapse.
So the foundation is set. A robust, diversified structure, anchored by a high-margin component segment, and focused on resilient markets. Okay, now we can transition to the actual strategic pivot, the move that changed GEA from a cyclical equipment builder into a high-quality industrial compounder, building the service economy. Their revenue model is a hybrid. Cyclical new machine sales create the installed base, and then the highly resilient, high-margin aftermarket and service business monetizes that base basically forever.
That service side is the golden goose. Project sales are necessary, but they're volatile. Service revenue, which covers parts, maintenance, upgrades, digital solutions, is recurring. It's non-negotiable for the customer, and it's significantly higher margin than the initial machine sale. This is where the magic happens for risk reduction.
And this wasn't some organic accident. It was a core, aggressively executed strategic objective, something they started focusing on even before Mission 30 was formally announced. The sources showed the service share grew from 32.3% of total revenue in 2019 to 38.9% in 2024. That's a strong shift.
And the momentum continues to accelerate, which is the key takeaway for you, our listener. By the third quarter of 2025, they didn't just meet, but they surpassed a crucial psychological milestone. The service share hit 40.1% of total revenue.
40.1%.
Yeah, and this achievement was organic, driven by 7.3% growth in the service segment alone, well ahead of overall group growth. Crossing that 40% recurring revenue line is often when the market re-rates an industrial company, because it recognizes its lower risk profile.
That 40% milestone is fascinating. But why is this revenue stream so inelastic? What makes GEA's service business a genuine competitive moat rather than just a nice add-on?
Well, it's a combination of vast scale, regulatory enforcement, and process integration. And all of those together create almost insurmountable switching costs for the customer.
Let's start with the scale and the vast installed base.
Okay. GEA has been operating globally for well over a century. They have equipment installed in tens of thousands of critical processing facilities worldwide. This installed base acts as a permanent, captive audience. When a high-specification separator or a major processing module needs maintenance, the customer's priority is not saving a few bucks, it's minimizing downtime. The ODM GEA offers guaranteed original parts, certified technicians, and deep proprietary knowledge, making them the default, lowest-risk maintenance provider.
That makes intuitive sense. If my multi-million euro production line goes down, every hour of lost production costs exponentially more than the premium I pay for the OEM service.
Exactly. But the second factor is the legal and procedural enforcement, which is the strongest lock-in mechanism, is the high switching costs due to regulatory hurdles.
Walk us through that, the regulatory lock-in mechanism. How does the government essentially mandate the use of OEM service?
Think about their two largest end markets, pharmaceuticals and food. In pharma, they operate under Good Manufacturing Practices, GMP. In the U.S. food industry, you have the Food Safety Modernization Act, FSMA. These regulations mandate extremely strict validation of the entire production process to ensure purity, safety, and consistent quality.
Okay, so if a key component, say a specialized freeze dryer that's essential for vaccine production, needs replacing, what's the consequence of choosing a third-party or non-certified part?
The consequence is catastrophic. Changing a key validated component, even for an upgrade, requires the customer to undergo a costly, time-consuming, and rigorous revalidation process of the entire production line. This process can take months and involves massive regulatory paperwork, testing, and potential audit risks. The cost and disruption of revalidation far outweigh any potential savings from choosing an unauthorized or cheaper service provider.
So the plant manager isn't just deciding between GEA and generic parts go. They are deciding between guaranteed regulatory compliance and months of regulatory uncertainty. That's an ironclad lock.
It absolutely is. And it guarantees pricing power and recurring revenue in these mission-critical verticals. The third component is process integration. GEA doesn't just sell single machines. They sell proprietary engineered systems. A liquid and powder technologies line is often designed specifically to integrate GEA's own high-margin SFT components and HRT cooling units.
Meaning, if you swap a GEA component for a rival's, you risk disrupting the whole finely tuned proprietary system.
Precisely. It's an ecosystem lock-in. The intellectual property lies not just in the individual component, but in how all those components talk to each other to deliver a guaranteed yield or purity level. Trying to introduce a foreign component breaks the guaranteed process. This structural advantage, combined with their sheer scale and proprietary process knowledge like the fact that they are cited as being involved in the production of every third chicken nugget globally, it just reinforces the entire competitive moat. It's a textbook definition of high barriers to entry.
Okay, so they built the structural foundation and reinforced it with the service mode. But let's look at the financial proof that this operational shift actually worked. The story from 2019 to 2024 is remarkable because the revenue growth was modest. It's a true story of internal operational mastery.
It's crucial we stress the low growth because it confirms the nature of the turnaround. Top-line revenue growth was steady but not explosive. It went from $4.88 billion in 2019 to $5.42 billion in 2024. That's a CAGR of only around 2.1%. The market wasn't growing them. They were fixing themselves from the inside out.
And that fixing process was encapsulated in their strategic plan, Mission 26, and the execution track record here is what gives them credibility today.
Massive credibility. Management launched Mission 26 as a deep efficiency and restructuring program. It was aimed at improving internal processes, supply chains, and portfolio focus. The astonishing fact is they achieved all the core financial targets of that plan in 2024, a full 2 years ahead of schedule. That demonstrated both strategic clarity and highly competent execution. They didn't just meet expectations. They decisively beat their own timeline.
So let's quantify that success through the margin expansion story. This is the clearest evidence of structural improvement.
The adjusted EBITDA margin is the headline figure, no doubt. In 2019, the margin was a disappointing 9.8%, which is well below what top-tier industrials command. By 2024, through the combined effect of internal efficiency gains and that favorable shift toward the high-margin service mix, they achieved 15.4%. That is a structural increase of 560 basis points in just 5 years. That margin expansion is what separates the old, inefficient GEA from the new, focused model.
That 560 basis point jump isn't accidental. It means the management team went into every segment and solved deep-seated systemic operational problems. But I think the most important metric, the one that truly shows managerial quality, is the superior capital returns. Let's dive deep into the return on capital employed, the ROCE surge.
The ROCE surge is the ultimate proof of success. ROCE tracks how efficiently management deploys every single euro of capital entrusted to them. GEA's ROCE expanded from 10.6% in 2019, which, signaled a pretty average asset utilization, to an elite 33.8% in 2024.
That's a 3.2-fold improvement.
It is a 3.2-fold improvement.
Why is achieving 33.8% ROCE so rare and impressive for a company that designs and builds heavy industrial equipment?
For most industrial companies are fundamentally asset-heavy. They need huge factories and large inventories, which inflates the capital employed denominator in the calculation. Achieving 33.8% ROCE requires two things at the same time: stellar margins, which they achieved, and incredibly tight control over the capital base. The massive ROCE surge is a direct reflection of the strategy, shifting capital allocation away from low-return, asset-heavy new machine projects toward the high-return, capital-light aftermarket service business. This shift structurally minimizes the capital required to generate profit.
To achieve that, they must be generating phenomenal cash flow, which is often a cleaner measure of earnings quality than just the reported net income.
Absolutely. The quality of their earnings is exceptional. Their free cash flow, FCF, reached $504.8 million in 2024. But more telling is the FCF conversion, that's FCF relative to net income, which stood at an impressive 131% in 2024. A conversion rate over 100% is highly desirable. It means they are translating more than 100% of their accounting profits into actual, usable cash. This confirms that the profits are high quality and not being diluted by, accruals or balance sheet maneuvers.
And that high FCF conversion is directly linked to how they manage their assets, particularly net working capital or NWC. This is a technical term for how efficiently they manage inventory, receivables, and payables.
This NWC story is a masterclass in efficiency, and it directly explains the source of that abundant cash flow. Superior working capital management means they are extremely quick at collecting payments and very disciplined about carrying excessive inventory. They systematically reduced net working capital as a percentage of revenue from 14.0% in 2019 to an exceptionally low 6.0% in 2024. Let's translate that 6.0% NWC into practical business language for the listener. What does cutting NWC by more than half actually mean for the company? It means that GEA has effectively released hundreds of millions of euros in cash that was previously trapped inside the business. Imagine cash stuck in inventory sitting on a warehouse shelf or in receivables that customers hadn't paid yet. By aggressively optimizing the supply chain and tightening payment terms, they essentially converted those stagnant assets into immediate, available cash flow. This freed up cash is exactly what they are now using to fund their share buybacks and target value-enhancing M&A. This is arguably the most underrated part of the operational turnaround story.
Okay, so the turnaround is confirmed, successful, and complete. Now let's pivot to the future. What we're seeing in the most recent numbers, specifically from Q3 2025, is that the momentum isn't slowing, it's accelerating, despite a challenging global economic climate.
The Q3 2025 results are a vital piece of the puzzle. They demonstrate that the 2024 numbers were a floor, not a ceiling. Even as global mechanical engineering saw some softness, GEA's order intake grew 8.4% organically. That level of order growth is a huge leading indicator. It shows that demand remains robust in their critical sectors, especially pharma and automated farming.
And their operational leverage is clearly kicking in, pushing profitability to new highs.
Precisely. The structural efficiency improvements mean that every new euro of revenue drops more efficiently to the bottom line. The adjusted EBITDA margin expanded by another 90 basis points year over year in Q3 2025, reaching a new record high of 17.0%. And again, ROCE continued its ascent, hitting 35.4% in the quarter. The machine is running hotter and more efficiently than ever before.
Okay, that brings us to the new strategic blueprint, Mission 30. Announced in late 2024, this plan shifts the focus entirely from fix it to grow it, built on the pillars of growth, value, and impact. Let's look at the headline targets they've set for 2030 because they are audacious.
They really are. The credibility they established by executing Mission 26 2 years early is now being leveraged to set world-class aspirations. First, they are accelerating the top line, targeting an organic revenue CAGR of over 5.0% through 2030. That's a significant bump from the 3.7% they achieved in 2024.
Second, the margin target is high, an EBITDA margin of 17.0 to 19.0%. But wait a minute, they already touched the low end of that target range in Q3 2025. Does that suggest management is perhaps sandbagging the 2030 target?
That's a valid and critical question. Hitting 17.0% so early in the plan suggests two possibilities. Either they are sandbagging, leaving plenty of room for error in future beats, or they expect significant margin pressure in the short to medium term that requires them to start from a high base. Given their track record, I lean toward the idea that the 19.0% upper bound is far more attainable than it appears. It implies only a 200 basis point improvement over the next 5 years, which is actually slower than the pace they just demonstrated.
And then there's the ROCE target. This is the metric that truly defines their ambition to be an elite compounder.
Absolutely. They are targeting a ROCE of over 45.0% by 2030. Let's just reiterate that. They are aiming for a 45% return on capital employed. This is an incredible goal for any industrial business, demanding almost perfect capital-light execution and a relentless cash conversion.
Yeah, achieving over 45% ROCE is not the norm. It's reserved for companies with minimal fixed assets or extremely high technological margins. It implies zero wasted capital and flawless execution of their 3 growth drivers. Let's start with strategic growth driver 1, the service business acceleration.
So we saw the service share hit that 40.1% mark recently. The target now is to grow that service revenue to approximately $2.9 billion by 2030. That's a conservative yet consistent organic CGR of over 6%. But the strategy is evolving beyond just selling parts. They're shifting toward performance partnership programs.
What does that entail practically?
It means using digital and AI solutions to move from reactive maintenance to proactive performance guarantees. They are installing sensors, using remote monitoring, and leveraging predictive analytics to ensure customer uptime. So instead of simply selling a part when it breaks, they sell a guaranteed level of throughput efficiency. This deepens the customer relationship, makes the revenue even stickier, and crucially, it allows them to command higher pricing for guaranteed performance.
Strategic growth driver 2 taps directly into the megatrend of sustainability, green CapEx.
This is a massive opportunity, and GEA is positioned as a key enabler. Customers aren't just buying new machines, they are buying solutions that fundamentally reduce their energy consumption, water use, and carbon footprint. This spending is often non-discretionary. It's driven by increasing regulatory standards and pressure from large B2C customers who have their own net zero mandates.
What is their concrete target here?
They aim to grow the share of revenue derived from sustainable solutions from 41.5% in 2023 to over 60% by 2030. This is a huge shift in their sales mix.
Can you give us a tangible example of what a sustainable solution sale looks like for GEA?
Sure. Look at industrial heat pumps, which fall into the HRT segment. Many food and beverage producers currently rely on natural gas boilers for necessary heating processes. GEA sells industrial heat pumps that use electricity, often sourced from renewables, to replace those fossil fuel systems, dramatically reducing the customer's operational carbon footprint. And they can demonstrate a clear return on investment, an ROI, for the customer through long-term energy savings. That makes the sale highly attractive even at a premium price point. This ability to link sustainability to customer ROI is what powers this growth driver.
Okay, finally, strategic growth driver 3 focuses on hyper-growth verticals where they have a specialized advantage.
The 2 big ones are pharma and new food. In pharma, they are targeting high-value niche technologies like continuous tableting solutions, where they seek a phenomenal 15 to 20% CAGR through 2030. That is aggressive growth for a legacy industrial company. It suggests either substantial market share gains or targeted technology-focused M&A. And the segment is highly attractive due to that robust regulatory lock-in we discussed earlier.
And new food, which covers alternative proteins. This is where innovation is happening fastest.
Exactly. This includes plant-based foods, but increasingly the sophisticated future of food, precision fermentation, and cultivated meat. These require highly specialized, sterile, and resource-efficient processing equipment, precisely GEA's wheelhouse. To capture this, they are investing capital, as you can see from the opening of their new Food Application and Technology Center in Janesville, Wisconsin in 2025. This shows they are building the infrastructure and expertise now to monetize these trends through 2030.
To attempt such aggressive targets, especially that 45% ROCE, requires absolute confidence in their financial footing. So let's look at their balance sheet, which is repeatedly described as a fortress balance sheet.
Their financial policy is highly conservative, which provides massive flexibility. At the end of fiscal year 2024, they were in a position of incredible strength. They reported net liquidity of $343.5 million. And to be clear for you, our listener, that means they had significantly more cash on hand than total financial debt and lease liabilities. This is a very comfortable, debt-free position.
The sources noted a slight shift in Q3 2025, where they registered a minor net debt position of $36.3 million. Was this a sign of weakness?
Absolutely not, and this is a crucial distinction. The source confirms this small shift was intentional. It directly reflects the significant cash outlay required for their large share buyback program. It was a planned capital allocation choice returning cash to shareholders, not a result of operational strain or poor performance. Their overall credit health remains stellar.
And the credit rating reflects this prudence and execution?
Correct. They hold a strong investment grade rating of Ba1 with a stable outlook from Moody's, which was upgraded in 2023. This is essential, as it secures low-cost financing for future growth, particularly for M&A.
Okay, let's analyze the capital allocation policy, because this is the roadmap for achieving that 45% ROCE.
Their policy is clear and disciplined. It follows a waterfall approach.
Right.
First is reinvestment, but this has to be capital light. They only target normalized capital expenditure, CapEx, at 2.5 to 3% of sales. This low CapEx ratio is structurally necessary to sustain a high ROCE. They must grow without significant asset bloat.
Second is shareholder returns, which appear substantial.
They're committed to both a stable and rising dividend, 1.15 per share proposed for 2024, and substantial share buybacks. They spent $230.5 million on buybacks in 2024 and announced a new $400 million referral program. This signals that management views the stock as undervalued and is actively using its significant excess free cash flow to reduce the share count.
And finally, M&A. Do they have the capacity to pursue large transformational deals?
They have the stated intent and the capacity. They will pursue value-enhancing acquisitions. These are likely to be bolt-on deals to enhance their technology portfolio, perhaps focusing on the digital or pharmaceutical segments where they're targeting that hypergrowth. Their balance sheet is ready to accommodate these deals without taking on excessive leverage.
This disciplined approach is great, but how does management ensure they don't resort to value-destructive growth or M&A just to hit those aggressive Mission 30 targets? This comes down to management alignment.
The incentive structure is specifically designed to enforce capital discipline. It's really smart. The short-term incentive, the STI, is tied to two metrics, EBITDA and RONE. So they are compensated for both profitability and how efficiently they use capital. If they drive profit by wildly increasing capital expenditures, their bonus suffers. The long-term incentive, the LTI, is tied to relative total shareholder return, or TSR, compared to their peer group, compelling them to deliver market-beating performance over several years.
And they have serious skin in the game, ensuring personal alignment with long-term shareholder returns.
Yes. Executive board members are required to hold between 100% and 150% of their base salary in GEA stock. This is a mandatory commitment. They have to buy and hold shares, ensuring their personal financial success is directly linked to the company's share price performance over the long haul. This structure really prevents short-term decision-making that could harm the long-term compounder narrative.
Okay. The management credibility is high, the execution is proven, and the balance sheet is pristine. But no company is without risks, especially one attempting such an ambitious transition. What are the key challenges that could derail the success of Mission 30?
The primary risk remains external cyclicality, no question. While we celebrated the 40% recurring service revenue, that still means approximately 60% of their total revenue is derived from cyclical new equipment sales.
The project side of the business.
Exactly, the project side. If we enter a deep, protracted global recession, or if interest rates remain high, customers will defer capital expenditure projects, and that 60% segment will contract, directly impacting their ability to hit that 5.0% CAGR target.
And for a global exporter reporting in euros, currency volatility is a persistent headache.
It absolutely is. It's the invisible friction on their reported growth. The strong euro, in particular, acts as a persistent FX headwind, masking the organic growth. For example, in Q3 2025, while the organic revenue growth was strong at 4.5%, negative currency translation effects totaled $37 million. That reduced the reported growth dramatically. If the euro continues to strengthen, it will make meeting the revenue target feel much harder than the underlying operational performance suggests.
And we must revisit the sector concentration risk.
The concentration risk related to the volatile dairy market is significant. It accounts for about 30% of sales. While they are geographically diversified, a major structural disruption in global dairy consumption or pricing, maybe due to a rapid consumer shift or new trade barriers, could create a sustained headwind that would be very difficult to overcome.
Finally, the execution risk, just the sheer ambition of the targets.
The execution risk for Mission 30 is palpable because the targets are set at an elite level. We're talking about over 45% ROCE. This demands flawless integration of every acquired asset, impeccable management of working capital, maintaining that 6.0% NWC, and hitting those hyper-aggressive 15 to 20% growth rates in pharma. If they misstep on a major integration, or if the new food market doesn't scale as quickly as anticipated, the market will severely punish the failure to meet what are, by any measure, extremely high expectations.
So we've established the structural quality, the operational success, and the ambitious path forward. Now, the final question. How does the market currently view this company?
The market has certainly recognized the turnaround, which is reflected in the current trailing 12-month multiples. As of mid-November 2025, GEA trades around a PE of approximately 22.8 times and an EBITDA of roughly 11.8 times. Now, this is a higher valuation than the pre-turnaround numbers, but we need to compare them to their top peer.
Their primary competitor in the high-margin segment, specifically separation and flow technology, is the Swedish firm Alfa Laval.
Correct. Both are established, top players, but the crucial observation is the valuation disconnect. Despite GEA demonstrating superior capital efficiency, a 33.8% ROCE in 2024, and achieving that 40.1% recurring revenue milestone, GEA trades at a noticeable 10 to 20% discount on an EBITDA basis compared to its highest quality peer, Alfa Laval, which trades closer to 14.1 times.
So what does this all mean? If GEA has the superior capital returns and a proven management team, why does the market still price this discount into the stock?
It's likely a combination of three factors. First, historical stigma. The market often takes years to shed the perception of a company that was once perceived as an underperforming, complex, cyclical industrial conglomerate. The memory of the low 9.8% margin and 10.6% ROCE back in 2019 still weighs on its valuation.
Meaning the market hasn't fully digested that the fix is permanent.
Exactly. Second, the complex structure and the concentration risk. Despite the geographical diversification, that 30% exposure to the volatile dairy market makes some investors nervous compared to a more broadly diversified peer. And third, the market may be questioning the achievability of the most aggressive targets, particularly the 45% ROCE. It's demanding proof of execution before closing that valuation gap.
This means the investment thesis has profoundly shifted, hasn't it?
Fundamentally, the era of GEA being a deep value turnaround story from 2019 to 2023 is over. That value has been realized through operational repair. The new thesis is a high-quality compounding story from 2024 onwards. The downside risk is protected by the balance sheet near zero net debt and massive SCF in that stable service mode. The upside depends entirely on two things: management flawlessly executing Mission 30, and the market finally eliminating that 10 to 20% discount as it acknowledges GEA as a true compounding peer.
It's a compelling synthesis. We have a highly disciplined, execution-focused management team that has proven they can deliver structural efficiency improvements. And they are now aiming to monetize massive secular trends like sustainability and new food production. The data really validates the quality.
It does. They have successfully de-risked the business by shifting their center of gravity toward high-margin recurring revenue. They have the flexibility to seize growth, and the structural tailwinds are significant. The remaining question is whether their discipline is high enough to transition from being the turnaround heroes to becoming the elite compounding champions of the industrial technology space.
A truly comprehensive deep dive into an evolving industrial narrative.
Indeed. To leave you with a final thought, let's go back to that phenomenal stretch goal. GEA is targeting a return on capital employed, a ROCE, above 45% by 2030. That level of efficiency is extremely rare. Given that management's long-term incentives are directly tied to that aggressive ROCE metric, what internal trade-offs in terms of maintaining that exceptionally low 6.2% working capital ratio, limiting vital long-term R&D spending, or maybe foregoing attractive but capital-intensive M&A opportunities? What will they have to enforce over the next 5 years to hit that target? The tension between driving market-leading growth and maintaining capital-light efficiency will define their success. And the consequences of falling just short of that 45% mark could be severe for investor sentiment. That is the central challenge that lies ahead for GEA.